Hello, good evening, everybody, and welcome. And also, welcome to our Facebook audiences as well. Thank you for joining the webinar tonight. Tonight, we're going to be discussing how to buy and hold the key to wealth. So, before we get started, a few ground rules. If you have questions throughout the presentations, please type it down in the chat and we will get it in the order it was received. And without further ado, let's go ahead and get started. Allow me to introduce the founder of Nhan Lam Academy, Mr. Nhan Lam himself. Nhan, can you hear me?
Yes, I can. Can you hear me?
Oh,
Okay, can you hear me?
yes, loud and clear.
Okay, perfect. Well, thank you very much for that warm welcome, Vaughn. And for those who are attending tonight, thank you so much for joining in tonight's webinar. I tell you, the topic tonight is one of my favorites. Now, for those who don't know me, my name is Nhan Lam, and I've been investing in real estate for over 10 years now. I started off on a part-time basis while I still had my full-time job as a federal contractor as an engineer and was still working full-time there. Within 2.5 years of working real estate part-time, I completed 12 total deals and was able to replace my full-time job and have been doing real estate ever since then in all kinds of facets. I started off in fix and flip and then eventually learned how to wholesale, eventually learned how to do buy and hold and rentals, and then later on do how to do financing and a number of other things that makes real estate really exciting and very versatile when it comes to achieving financial goals. Okay, so tonight, guys, let's go ahead and go into the topic itself. As we pull up our slides here, the buy and hold is one of the biggest benefits of real estate because of tax advantages. All right, but let's go through our different strategies on why buy and hold and why you should do it the right way, so that way you can have a life and you can focus on acquiring new properties without the headache of having to manage all the tenants at the same time. Okay, so let's go through this real quick. First, why should people buy and hold? Well, key question, okay? One of the main reasons is long-term wealth. If you buy a rental property, your tenants will pay rent. As they pay rent, that rent will pay a mortgage and also the expenses attached to the property. As the mortgage gets paid down, assuming there is a mortgage, then you increase your principal and equity over time, and eventually you own the property outright, but you personally did not pay for that. So that's long-term wealth, all right? Also, depreciation and tax advantages. So, of course, as the building you own over time, it depreciates because the materials used to build that has depreciated in value over time. The lumber, the carpet, the appliances, the cabinets, all the materials associated with building it has depreciated. Now, does that mean that your property value has decreased? The answer is probably not. Historically, residential properties increase in value over time in the long haul, but the cost of the building materials used to build the property depreciates in value in that actual essence. Okay, so you can depreciate the building itself, so that way you can reduce your tax liability. All right, in addition to that, you can have cash flow, and of course you want to make sure your numbers are correct to where your rents are higher than your expenses, so that way you can cash flow positively. And then of course, possible appreciation. Now, notice I said the last thing on this list was possible appreciation. Now, can we count it all the time? The answer is no. For those who remember about 10 years ago or so, we went through the Great Recession and property values went down due to a huge foreclosure market due to a financial crisis that happened to the banks. Okay, so overall real estate values do go up, but there are some parts of time where things recess and things will decrease in value. Now, you should never count on appreciation. You should always use that as a bonus. If it appreciates, that's a bonus. If it doesn't appreciate, at least you still cash flow and you can pay off your mortgage and weather the storm if a recession should occur. Okay, so what is your criteria for buying? What should you look for when buying an actual rental property? Is it location? All right. Is it price point? What kind of price points do you think you can afford or be willing to take a risk on? What kind of cash flows are you looking for? How about line of sight? When you walk out of the property, what do you see? What's it around? Is it around other residential properties near a school or recreation area? Or is it near a loud commercial area or industrial site where there's heavy traffic that may not be very desirable? Okay. So line of sight is key as well. And also tenant quality. What kind of tenants are you going to attract? All right. Are they going to be white collar tenants? Are they going to be blue collar tenants? Are they going to be Section 8 tenants? What kind of tenants do you want to attract in your business? Okay, so here's what we have put down for our personal criteria that we use. Now, this may not be everyone's criteria, but I want to share everyone what we do as a rental criteria. First of all, when we buy a rental property, it must cash flow positive from the get-go. It cannot, there should be no point in time where cash flow is negative. It must cash flow positive from the beginning. Okay. And also, we want to be able to get it for free eventually, meaning that we don't have any money tied to that property whatsoever, but yet we still own it and we still cash flow from the rents. Okay, so let me give you guys a couple of examples of what we have accomplished and what we've done when it comes to buying rental properties. Okay, here's a property that we purchased in Woodbridge, Virginia back in 2017, a few years ago. All right, here's the situation. The owner of the property lived long distance and they were a DIY landlord, and that stands for do it yourself. They used to live locally, but they were doing everything themselves, managing it themselves, fixing things themselves, and did not want to hire a single person when it comes to servicing the property. Over time, obviously, you get burnt out. And this landlord got burnt out with some tenants that was not paying rent on time, and there were constant mechanical or maintenance issues, and they were just flat out burnt out and wanted to get rid of the property. Okay. So at the time of us looking at it, the tax assessed value for 2017 was $214,000. It was 3-bedroom, 2-bath. At that time, the ARV after repair value was $250,000 if we repaired it for sale, and the as-is value was $200,000. So you ask yourself, based on these numbers, what would be a reasonable offer to give this the homeowner to purchase a property? Well, let's take a look. Okay. Okay, take a look at our numbers here. It was a turnkey tenant. The tenant was already living there. They're paying $1,600 a month, and by the 1% rule, we want to purchase it for $160,000 or better. All right, 1% meaning $160,000. 1% of $160,000 is $1,600 per month. All right, so that's the current rent that was being paid by the tenant, and we want to, of course, buy it better than what we needed to. So we ended up negotiating back and forth, and we finally got an agreement of $150,000 for the sale price with the tenant in place that we would manage later on down the road to get them to catch up, and also have to evict them if they don't catch up on time. So here's how we financed it. We got an 80% loan from a private lender, $120,000, and then we had a 25% seller help financing. All right. So all in all, if you add this together, that's 105% financing. All right. Now the 25% is $37,500 in numbers. Okay. But take a look at how we did this. When we purchased a property, every time you purchase a property, you get a settlement statement. And this right here is a HUD-1 settlement statement. If you take a look at the numbers, all right, we have $120,000 for the first mortgage, and then a second held mortgage by the seller, $37,000 some change. The tenants were in place. The lease was assigned to the new owner, which was us. And when we purchased the property, they gave us cash back at closing of $1,839. Can you guys imagine buying a house, but in order to buy the house, you must accept cash at the same time? Okay, that's exactly what happened here. No money came out of our pocket whatsoever, and we got $1,800 back cash at closing to the borrower, which was us at the end of the day. Okay, so here's how it all worked with the numbers and cash flow. We got, not only did we get $1,800 in cash back in closing, but here's the rental income with $1,600. The taxes roughly $200 a month. Insurance $75 per month. Maintenance and repairs and vacancies throughout the year were average about to be $80 per month. Property management, which was 8% of the actual rent, $128. The first mortgage of $120,000 was only $700 a month. And then the second mortgage at $37,500 was only at 6% at $187.50 per month. So the actual cash flow was $229 per month. All right. So we bought the house. We got $1,800 cash back at closing. We owned the house, and they were making money, $200 a month in cash flow every single month. But to add insult to injury, we also depreciated the property at the end of the year and saved money on our tax liability. All in all, we were able to save roughly $200 per month in tax liability because we depreciated this property, totaling a cash flow of $449 per month. All right. So take a look at this, guys. In addition to that, We also got an appraisal done, all right, of the property as is, and we did not spend any money fixing it up whatsoever. It appraised for $230,000. But remember, we purchased it for $150,000. So not only did we get $1,800 back at closing, not only are we cash flowing $449 per month in cash flow and tax savings, we're also increased our net worth of $80,000 instantly. All right. Ask yourself, where else can you go and increase your net worth by $80,000 just like that? Can you do that in the stock market? No, you can't, but it takes time. Can you do that in a mutual fund or a 401k? Yeah, but definitely it takes years to build, okay? But you can't do it just like that, like this example here in real estate, which is very exciting, okay? Here's another example that was more recent. This one we purchased just last year in 2020. Now, this one was a little different. This one we applied what's called the BRRRR strategy, BRRR, which is buy, renovate, rent, and then refinance, okay? So in this situation here, which actually just down the street from the other property you purchased a few years ago, the seller was local, but they're also a do-it-yourself landlord, all right? Similar type situation, but the landlord was local. The seller's thinking is that the home is worth more than it is, but there was a bad tenant in there, which eventually we had to help them evict to get rid of. And they also did not want to hire an agent and pay 6% commission because they wanted to do everything themselves. Okay, the tax assessed value in the year 2020, the year we bought it, was $262,000. It was 3-bedroom, 2.5 bath. It was also an end unit. And when we took a look at the condition of the property, we estimated it would cost about $15,000 to make it rent ready again. Now, $15,000 doesn't mean we're going to change everything new like we would a fix and flip. We will make it rent ready to make sure everything's working, everything is sanitary, everything is livable, and qualifies for a tenant to move in safely and without any kind of risk to them because it's rentable. Okay, the ARV after we do the renovation was $300,000. So ask yourself this question here: based on this number, okay, based on these numbers right here, how much would you offer to these sellers? All right, if the ARV was $300,000 and the tax assessed value was $262,000, most people would offer in the $200,000 range or maybe a little bit more. Well, guess what? Not us, because we knew the sellers were so motivated and we were the ones who were willing to buy it with cash with no home inspection. We closed quickly and there was no financing contingency. There was no appraisal contingency. There was no contingency whatsoever. The seller was willing to agree to us with absolute certainty that we will close within 2 weeks because they need the money pretty quickly. We purchased this property for $140,000. All right, $140,000. So here's take a look at our numbers. Okay, the acquisition numbers are the numbers on the left hand side. All right, the purchase was $140,000, closing costs roughly $3,000. We need to spend about 3 months to be able to renovate the house and find a tenant at the same time. Now the renovation didn't take long. It took about 4 to maybe 6 weeks to do the renovation. But we also had to take pictures and spend about a month or so looking for a tenant. And once we do get a tenant, given the enough time for them to move in on the first of any given month. Okay, so $5,000 for holding costs, which includes our interest paid on the mortgage, includes any real estate taxes we have to pay at that time, and also HOA fees along with insurance and also taxes. Okay, renovation cost $15,000, so our total cost in was $163,000. All right. Well, guess what? Before a tenant actually moved in, we went ahead and went through a refinance to remove ourselves from a hard money lender and got a traditional mortgage. We were able to get a new loan of $210,000. All right. That was 70% of the appraised value. The appraisal came back at $300,000. So 70% of $300,000 is $210,000. Well, we refinanced it. There's refinance costs with closing costs and points on the loan. For a total of $4,500. So the net proceeds that came to us was $205,000. All right. So take a look at this, guys. Take a look at those two numbers, the total cost in and the net proceeds after refinance. All right. We got a total of $42,000 and change cash out of this property after we refinance. Now, what did we do with this money? We use that money to look for the next deal. You can do whatever you want with this money, okay? But the smart thing to do is probably put it in the bank to look for the next deal, so that way you can increase your net worth and a rental portfolio over time. Okay, so take a look at the numbers from a cash flow perspective. Eventually, we were able to get a tenant where the rent was $17.50 per month because it was an end unit and it was renovated very nicely. The HOA was $110, real estate taxes $250, insurance, property management, repairs, and so forth set aside, and also the debt service. You take a look at all the numbers, do the math. The actual cash flow came out to $251 per month, actual numbers. And then, of course, with depreciation, we're saving another $200 per month from depreciation for a total cash flow of $451 per month. Okay, so remember, we already got $42,000 of cash out when we refinanced, but we also are cash flowing $450 per month, including our tax savings. All right. In addition to that, our new value of the property was $300,000. The new loan was $210. So our net increase of equity, bam, just like that, was $90,000. Just imagine, guys, if you did this 10 times, maybe once per year, and that's all you did, all right? Once a year, you'll be close to becoming a millionaire at the end of 10 years just by doing this one simple thing. And it doesn't take long to do. All you need is one deal per year. And by the 10th year, your net worth is be $1 million, if not more, plus your cash flowing, plus your depreciating, plus you're probably getting cash back from refinances to do the next deal. All right. So the snowball effect is very exciting if you stay disciplined enough to do this once every year, if not more often, if depending on how excited you are with that. Okay. So once you get the rental property, of course, that's your part as an investor itself. But what should you do on the back end when you have an actual tenant? The answer is you should not do everything yourself. You should not be doing maintenance calls. You should not have to find your own tenants. You should not have to find and pre-screen your own tenants and then find out if they're going to pay the next month's rent or not. All right. You don't have to do the eviction process. Okay. What you want to do is have a good property management company. And a property management company who knows what to do to help you cash flow and also help alleviate your time so that way you can focus on finding the next deal instead of handling the tenants at hand currently, okay? And I can't think of a better person to go through what property management is all about and what he does for us. John Malatesta is with PMI of Fairfax, and he is the one who manages all of our rental properties and does a fantastic job, all right? He removes the nightmare, the late night calls, and he does everything with him and his company. And we're very excited to have him here as a guest speaker. So without further ado, I'd like to introduce John Malatesta to share his part of the presentation about property management. So John, are you there?
I am. Can you guys hear me well?
Yes, we can. Go right ahead, sir.
Awesome. Great. So yeah, if you guys have any questions during this part, yeah, feel free to put them in the chat and I'll try to get to them. I'll try to answer them as quickly as I can. But there's a kind of a Q&A at the end. I know that. But yeah, Jan asked us to give a little bit of a presentation about what we do and what you should look for in a management company, things like that. So we'll put this together for you guys and hopefully it helps fill in some gaps and get you guys pointed in the right direction. So the very first slide here is pretty self-explanatory. What can a property management do and should I use one? And there are a couple scenarios where maybe a property management company is not needed. Kind of an odd thing to say. Maybe don't hire me. That's a weird thing for a salesman to say. But in honesty, there are a few situations where you might want to do it yourself. If you have one property very close to your primary residence, you're very familiar with the neighborhood, you know the ins and outs. Maybe you have a little bit of a contractor base already. Then those sort of things, and you're learning the ropes, that's okay. If you own a duplex and you rent out the second half, you live in the other half, that would be fine too. And if you are renting a room or a basement in your primary home, you're so very close to those things that the benefit of the property management company doesn't necessarily outweigh the weight and the cost. So when should you use them though? When you have multiple homes or you're very far from the homes. We manage all of Northern Virginia, so we're centrally located in Reston, but it could take an hour to get to one of your homes. If you're at work and there's an emergency call, it could be 2 or 3 hours before you're even able to get to the call, 2 or 3 hours before you're able to get to the property. It could become more hassle than not. So it might be a good thing to consider when you're far away from. Second criteria when you probably want to hire a property management company is when you want to treat it like a business and not a hobby. I do suggest that you do that from the beginning. It gets you in the right mindset right from the beginning. It's not a hobby. This is a business, and you are going to run it like a business. So also, people with big hearts, tenants will pull on your heartstrings. They'll come up with a bunch of different stories, different things. My uncle's dog is sick, and I had to take care of him. I'm a nice guy. I can be a really nice guy. But again, going back to point 2, this is a business, and you want to treat it like that. So we treat it like a business, and the lease is the lease. All right. So this is a neat little infographic. Let's see a couple questions here. 8% normal PM fee. There is a slide actually. So yes, it'll be about 8 to 10% on average in Northern Virginia.
And John, we're actually going to do the questions at the end, okay?
Oh, sure, got it. No worries. I'll hit those at the end. But okay, so yeah, this is a neat little infographic we put together for the DIY versus property management company. What you have to do is pretty much everything if you're doing it DIY. The phone calls, the maintenance. You have to know the ins and outs and the new rules and regulations. There's been a big change in Virginia. Love it or hate it, marijuana is extremely legal now. Can you evict if they're smoking marijuana in your home? That's a good question. There's new rules, there's new laws that come out every year. We do tons of continuing education so that we know all the rules and regulations. However, if you hire somebody, you can basically sit back and allow them to do all that work for you, saving you time, money, energy, all the things that go into marketing a home, managing a home, and having that rental as an investment property. So they can be, property management companies can be a huge, huge asset for you in growing your business as a landlord. So what do we do? Really, you should look for a property management company that does A to Z. Starts from the very beginning by marketing the home fully, every website that's there, even sometimes in the paper. It's not necessarily a big thing up in Northern Virginia, but some of the rural regions, it's still pretty heavily found in newspapers. But things like the MLS, MRIS, Craigslist, Zillow, Trulia, the big names, everybody knows those. But there's a bunch of other little names, militarybyowner.com, forrent.com. They should market it fully. Get as many eyeballs on that listing as possible. And then show the home, secure applications, process the applications, know what you can and cannot screen for and against. If they have a felony, is that a no? Is that a yes? Can you allow felons? Again, this goes back to that continuing education to understand the rules, regulations, and laws. We make recommendations based upon experience and what we've seen in the past. It is a recommendation. We're not renting your home for you. There are a few management companies that are able to sign the lease for the owner. Personally, I don't recommend that because you lose a little bit of control as the owner. The paperwork, the lease, is it a valid lease? That's one of the big new changes for 2021. A lot of people don't realize that everybody is now underneath what's called the Virginia Landlord Tenant Act. Whether you have one property or 100, you fall underneath the Virginia Landlord Tenant Act now, and the courts are viewing everything through that lens. So again, going back to knowing the rules and regulations. And then of course, you get a tenant, get everything signed, you move them in. Then what? Well, you got the day-to-day. You got to collect the rent. You got to do the scheduled maintenance, air filters, regular inspections, condensation line cleanings. These are things that just happen and always need to happen. That's going to take time out of your day to find the next deal, find the next investment property, or you can spend time focusing on growing the business. Emergency maintenance, like Nhan was saying, he never gets a 2 o'clock in the morning phone call about a clogged toilet. That's a great day not to get that phone call. We obviously keep maintenance records, billing, everything for tax purposes. Obviously, you want to list out as many expenses so that depreciation and the expenses really get added up that really help grow that wealth quickly. And then, of course, tenants eventually move out. That is The move-in and move-out inspections are the two biggest things that non-professional landlords miss, and it bites them the worst overall. I've seen it bite them worst. Important factors to think about when you're considering a property management company. Remember that they have to keep the tenants happy too, not just you. Yes, they work for you, but the tenants pay the rent. So if they're not happy, they don't respond quickly about the issues, the washing machine doesn't work, they're going to get upset. You're less likely to keep them in the long run. They should keep you and the tenants in the loop of all aspects, whether it's a repair or if it's, hey, the tenant had a little bit of an issue and they're going to pay a couple days late. You should always be in the loop, and it should be information coming to you. If you do this, they'll stay longer. The tenants are going to take better care of the home. Your investment is going to be a much more profitable investment, and everybody's going to be happier overall. So this kind of goes to one of the questions, some of the costs. In Northern Virginia, you should kind of expect to pay anywhere between a half a month to a full month to rent your home. It's pretty average. You'll find some people that are different. Management fees on the day-to-day basis is 8 to 10% of the collected rent. Don't recommend flat fee because although it seems initially less expensive, they ding you and bill you for every little cost that you can imagine. And maintenance fees that can vary in Northern Virginia. Here in PMI, we're pretty much an open book. We don't hide anything. Our leasing fee is 75%, management fee is 8%. We don't have a maintenance fee. We don't have a renewal fee. We don't have an extension fee. Emergency after hours is all included. The way we look at it is we are your management company. We do it all, A to Z, full service. So, yeah. You should look for somebody of that sort of caliber. And questions. So yeah, I kind of answered that one question already for the fees and the costs. In general, though, if you see the flat fee managers, when you average it out, that's going to be about 11 or 12%. That's just a nationwide industry average. Yes, some months you're going to win, some months you're going to lose, but on an average, it is about 11 to 12% overall fee. So keep that in mind when you're developing your budget. Good, easy round numbers. Just do 10%. Although we charge 8%, just do 10%. It's easy math, and also creates a little bit more cushion for you guys. Obviously, there's my contact information. I'm happy to answer any other questions that I see pop up in the chat during the rest of the meeting and talk. So feel free to ask away any questions.
Okay, great. Well, John, I really appreciate the insight there. I'll tell you, one of the things I really love about working with you is that you don't nickel and dime everything. If there's a problem, you solve it. And sometimes you solve problems without me knowing about it, right? And that actually helps me out as an investor a lot because I can really focus on the next thing, the next deal, and so forth, and turn it over to you. So, with regards to questions now, guys, I'm going to turn it over back to Vaughn. And Vaughn is going to go ahead and read out the questions to everybody so that we can all hear and we can address the question. If the question is directed to myself or John, please communicate it as such. But if you have a question, please go ahead and type it in the chat so that way we can address all the questions. So Vaughn, I'll turn it over to you. Vaughn,
Hello?
are you there?
Can you hear me?
Yes, I can.
All right, awesome. So, first question is from Jonathan Dale. Do you have any reference for tax preparation? Someone who knows how to depreciate real estate, like your example, is hard to find.
Yes, that's a great question. You definitely need a very good CPA who understands real estate tax law on your team. And yes, they are hard to find, but I'll tell you, they do charge a lot, okay? But whatever they charge, they're well worth it. I mean, the one I personally have, I've used him for the past, I'd say 8-9 years now or so. And at the beginning, I thought he was very expensive, but throughout the years, he was worth every single dime. So yeah, and then there's a point too, and that person's CPA is no longer available to take new clients because he's so busy now. But I do have some other ones in the network that potentially could help you out. So feel free to send us an email at info@nhanlamacademy.com. Let us know which state your properties are in. And what I'll do is I'll see if I can get a licensed CPA who's licensed there to help you out understand tax laws and how to depreciate. They'll give you based on your tax bracket, they'll let you know what is the best thing to do. Should you depreciate it yearly, or should you depreciate all at once, or should you depreciate segregated, depending on if it's multi-unit complex or if it's a single unit complex, what's the strategy there. So yeah, feel free to email us and we'll do the best we can to send you the right person within the confines of what you're trying to accomplish. Okay. All right, Vaughn, next question.
It's still from Jonathan Dale. Is 8% of rent a normal PM fee?
Okay, I believe John did answer that question earlier. So John, do you want to reiterate anything about more about the property management fee?
Sure. There we go. I think you guys should be able to hear me now.
Yep.
Yeah, I mean, the property management fee should be about 8%, 8 to 10% in Northern Virginia is normal. You can find some less, you can find some more, of course. But really look through their services, their list of services that they do cover, and if there's any other fees that are associated to the life of the property, such as a renewal or an inspection or maintenance. A lot of management companies will charge a maintenance fee. Not saying that's not completely justified. I just personally disagree with it, hence why we don't charge one. But the maintenance fee can really add up over time, especially if you have an older property and there's a lot of call outs. Look for emergency fees, like emergency maintenance fees, things like that. But again, easy round number when you're doing your budget, just say 10%, and then it's easy math. And you know what? If nothing ever goes wrong and you get that 2%, it's 2% more money for you guys.
Okay, great. Vaughn, next question, please.
Jonathan Dale.
Yep, go ahead.
Yep.
Vaughn, you there?
Hello, can you hear me?
Yes, go ahead.
All right, the question. Do you provide lease documents and evictions, or do we need to hire an attorney to do it?
Yes, so the lease documents that we use are what's referred to as the VRLTA, or the Virginia Landlord Tenant Act lease. It's a standard lease in Virginia that's reviewed twice a year by Richmond and the attorneys and the governor down there to make sure it's applicable to all the new real estate laws. So yes, we do the lease that way. That way it's completely covered. There's no issues there. And yes, in the event of an eviction, we do file for our landlords. It is a little weird right now due to COVID. Some of that stuff is going away. It's good news. And the landlords are getting their rights back. So that's good news. But yes, we do file for that. If it's a non-payment of rent, if there is something else going on, we want to be very careful to make sure that we fully document it. So in that case, we would hire an attorney. The best example I can give is if we know that, let's say there's drugs being sold out of the home. Obviously, that's illegal. We can't allow that to happen, so we can evict for that. In those sort of situations, we would hire an attorney just to make sure everything is done 110%.
All right, great. Thanks, John. Vaughn, next question, please.
When are you guys doing the physical meetup again?
Oh, well, the physical meetups, that's a great question. Well, I'll tell you, we definitely will be doing them in 2022, okay? As for the rest of the year, we are not sure yet. Although I really miss seeing everyone in person, we also got to be careful as well with regards to different things, and also the availability of location and where we want to host it. Now, we'll always, we're still going to focus on the Gainesville Haymarket area. But if we were to do a live event again, the earliest we would do it is sometime in the fall, maybe October. But if not, then definitely in January of 2022, assuming all things go well and we don't have another spike in situations with the Delta variant or whatever's going on out there that people may be freaked out about. So I know some people are not scared about it anymore, and the CDC guidelines have changed. But that doesn't change the fact that we're still in a kind of awkward situation that we're trying to limit liability. So we're still trying to do our best to provide content, obviously virtually, but we understand the networking and the community is very important as well. So we want to get back there, definitely 2022, but earliest may be probably in the fall, depending on what's going on. So hopefully that answers the question. Okay. Any other questions, Vaughn?
Over back to you.
I'm sorry. Okay, so it looks like all the questions have been answered. So I'm glad you guys were able to answer the question, get your just to address your questions to John and myself. We definitely look forward to having you guys again next month at our next meetup. And next month, we actually will be having another guest speaker as well. And our topic is going to be where to find the money to fund your deals. Now, these deals could be fix and flip. They could be buy and hold. They could be whatever you need to be, which you need to do a double close. You can't do an assignment of a contract. So we're going to show you guys exactly how to find the money so that way you can maximize your leverage and use as little of your own capital as possible. All right. Now, usually we have our meetups on the second Wednesday of every month, but next month will be a little different because of a schedule conflict. So we'll be actually doing on the third Wednesday of the month of August on the 18th. So please mark that down. It's going to be the third Wednesday in August and not the usual second Wednesday, okay? If you want to register right now, please do so before it's filled up. You can click on the call to action on the on the top where the red button where it says click here, register now. Click there and save your spot. And then if you know anyone who's interested in how to find money to do their deals, please feel free to send them that link as well. So that way they can join in and learn from our guest speaker on how to find all the money you need to do as many deals as you want in the DC metropolitan area. So with that, guys, thank you very much for joining. Mr. Malatesta, thank you very much for all your guidance and your expertise on property management. And look forward to having you guys next month in the same place, same time, but on a third Wednesday of the month. Thank you very much and good night.